Amazon.
Well, if I didn't have coffee, I...
Quickly turn it over to the chair.
Good morning, everyone. Welcome. Rosemary DeBellis, representing Police Commissioner Kelly.
Barry Dennis, SIS.
Dan Torelli, PBA.
Joe Alejandro, PBA.
Pat Hendry, PBA.
Chris McGrath, PBA.
Paul Capitosto, SBA.
Steve Brabilia, LBA.
Roy Richter, CPA.
Michael Palladino, CPA.
Bob North, Actuary.
Barry Miller, Comptroller.
Martin Gaines, Controller's Office.
Seema Higurani, Controller's Office.
Thad McTee, Controller's Office.
Larry Schloss, Controller's Office.
Catherine Bernard, Controller's Office.
Justin Holtz, Department of Finance.
Janice Emery, Mayor's Office.
Bob Sanskisted, Pension Fund.
Kevin Holleran, Pension Fund.
John Murray, Controller's Office.
Carol Eglo, Controller's Office.
Anthony Galileo, Controller's Office.
Liz Calvin's Controller's Office. Pension Fund.
Okay, Larry, the floor is yours.
Did you want to start with something?
Joe, do you want to do...
I think we have with us today the Chief Actuary of the City of New York, being represented by Bob North. So, Bob, I believe you have an open item that you want the Board of Trustees to address.
Yes, I would respectfully request that the item that was laid over at the February 13th board meeting, which is the request for the preliminary fiscal year 2013 appropriation to the police pension fund, be voted for. The resolution draft is in Appendix C of a letter dated February 4 from the actuary, and I'll read the resolved for the record. Resolved that the employer contribution to the New York City Police Pension Fund for fiscal year 2013 be revised from $2,385,731,163 to $2,424,690,421, and such revision is hereby approved by the Board of Trustees. Any discussion on that before we vote?
No, I'd like a roll call vote.
All right.
Need a second?
We
For roll call?
We'll have a roll call vote,
Have
so.
a roll call vote.
Roll call vote, Controller,
Yes.
Finance,
Yes.
Mayors,
Yes?
PC,
Yes.
Barry will get you in there, say yes. PBA,
PBA votes no and will send a letter indicating why it has a no vote on this matter to be added to the record at a later time.
SBA,
Yes.
LBA,
Yes.
CEA,
Yes.
DEA.
Yes.
All right. 8-4, motion passes, resolution. And I thank the board.
And I thank you too, Bob, and thank you so much for that St. Patrick's Day outfit you have on today.
Excuse me?
Admire. I didn't know it was shirts like that didn't exist.
Neither one of us is very good with calendars, let me tell you.
I think you look great, Bob.
Why, thank you. Get the name of their tailors.
Okay.
Yes,
Yes, Madam Chairman, I have a request for, in addition to the executive session of the agenda, for us to have a follow-up discussion on the New York City-related Superstorm Sandy Recovery Fund.
okay, any comments on that? Will we-
Was this matter, forgive me, I was not at last month's meeting, so I just want to know, was this matter addressed at last month's meeting and voted on?
No, I don't think so, no.
Okay.
I
No,
think
just-
topic-
that it was voted
It
on,
was
but some
voted on,
additional
yeah.
information has come to light that we would like to discuss.
And what was the nature of the additional information? I wasn't sure. I usually take votes to be final.
Should we do it in executive session?
Would you
It should.
prefer to do
I
this
think
in
she-
executive
her
session?
motion was to do it in executive.
Yeah.
Yeah.
Exactly.
Okay, I just
Okay.
want to know, okay. All right,
And
so
I'd be
why don't we
very
address,
interested-
have the conversation?
Yeah, in the
On
executive
an
session.
executive
Okay,
session.
I'd be
so there'll
very
be a-
interested if we could, just at the beginning of the meeting, add things to the agenda.
Yes,
You've
well,
already,
that was an issue you brought up in the past.
To this development, to the extent that that's something that we decide to do.
Wasn't Bob North's item just added to the calendar?
No, I
as
think
well?
that was
Bob's
held
later.
over
Bob's
from
later
previous
on.
months.
Oh, I didn't see it, okay.
No, I
So,
actually made this
I know-
request previously, but for whatever reason, it didn't end up on the agenda.
Yeah, I saw an email a few days ago where it was requested to be added.
Was that sent out to all the trustees?
Was it sent to all the
Just to
trustees?
the chair and to the
That would be a problem. That's fine. Okay.
Okay. So, the first item on the agenda is performance review of the year and quarter ended December 31st. And Martin has the information, I think you've all gotten it. Before Martin starts, I just, that's good news, and then when we get to the January things, you'll like January a hell of a lot in January. So, look at the year, look at December, look at the quarter, good news 5 minutes later. Martin?
Yes, thank you, Larry. So, good morning. Anyone need any extra copies?
Big book.
Good? Good, we're on the board. So as Larry mentioned, he'll be going through January in just a few moments, and last month we briefly discussed December, but the quarter itself was ultimately a good quarter despite the concerns over the fiscal cliff, and as we found out subsequent to the end of the quarter, that there was negative growth in the economy, that the economy contracted. In the U.S. markets, the Russell 3000 was up a little bit less than 1%. Small cap was doing better than large cap, but the star was non-U.S. equity. Developed markets were up over 6%, primarily because stability started returning to Europe and volatility reduced, and the dollar was falling against the euro, or the euro was strengthening against the dollar. Emerging markets also did well. In core fixed income, we also saw slight increases, and high yield continued its rally up 3%, and for the year, you'll see up nearly 15%. So if you turn to page 9, you'll see the total returns for the fund, and you'll see the fund was over $27 billion as of December 31st. And on the left, the blue bar shows that the fund had a return of 217, ahead of the policy benchmark of 159. Fiscal year to date, we're exactly halfway through, and we're over 6.5%, slightly ahead of the benchmark, and the one-year return was, for the calendar year of 2012, was 1301 behind the policy benchmark. Note that the 10-year return is over 8%. The next two pages show the asset allocation. The first is without the adjustments. The second is the same on the top, which shows where the allocations are, but the bottom show the adjusted policies. And you'll see that on this page, what stands out, we're underweight, as we've been talking about for a while, core fixed income, tips, and overweight high yield. Next few pages have some information on attribution. And for the quarter, we were up 58 basis points, most of it from the management effect. Some of it is a lagged effect from private equity and some from U.S. equity. The allocation effect was roughly flat. For the 1 year, we were behind the benchmark, and the allocation effect was mostly due to cash early in that period. And similar for the 3-year numbers as well. So how did police do versus other large public funds over $10 billion? You turn to page 18, you will see that I'm in the middle of the page here, the 1-year number, your 1299. The 1299, this page was printed when it was a preliminary number. The actual number was 1301. Placed you in the 64th percentile, but for 3 years, you're right at the median and top quartile for 4 years. So you're in good company for the period of time since 2008. And for the 1 year, like I said, the 1299 number. I'm going to turn it over, unless there are any questions, to Seema for some comments on equity.
Thanks, Martin. So could you turn to page 21? This chart shows police's domestic equity return versus the benchmark. And as you can see in the bars here, the trailing 3 months, which is calendar Q4 last year, nicely outperforming the benchmark in that period, up about 80 basis points relative. Fiscal year to date as well, outperforming by nearly 80 basis points. And as you go out further, outperforming by less as you go out. But as you remember, we've made a lot of changes that I think are starting to be reflected. So if you turn to the next page, 22. So this goes through the domestic allocation. It's about 36% of the total portfolio for police. I'll just point you to a couple columns here. The index return, the actual return, and the difference columns. As Martin mentioned earlier, the Russell 3000 index for the quarter was up a little bit, about 25 basis points there. But just to differentiate, you can see the mid-cap index, it's kind of in the middle row there. The mid-cap S&P 400 index was up nearly 4%, so quite a difference in the quarter. And then just in the difference column, I mean, if you can see there, mostly across the board there was outperformance across small, mid, and large. If you turn to then page 29, which is international. So the total international allocation for police, about 16% of the total fund. Again, if you look at the 3 columns, index return, actual return, and the difference column. Again, as Martin mentioned, the international markets did far better than the U.S. Last quarter. You can see the EFA passive up 6.5%, and then the passive EM further down up 5.6%. Again, the Russell 3000 was up like 25 basis points. And then in the difference column, I just would point out that you see in the EFA section some underperformance versus the benchmark, but you'll remember that we completed the EFA search in Q4 of last year, and we've actually funded now those new managers as of this quarter. So we'll look to see how those guys do, and hopefully some improvement there. So if you then turn to page 30, you can go through some details on EFA. In these bar charts, so the purple bar is the EFA markets, and the yellow bar is the index. And you can see the split between active and passive, the green and the blue. So overall, in the quarter, a little bit behind the benchmark. Same with fiscal year to date, And then you're looking out 12 months. Again, I mentioned we finished our EPA search, so we would look to expect better performance out of those managers. If you turn then to page 36, emerging markets. In here you can see again, the purple bar being the police portfolio, the yellow bar being the index, and the trailing 3 months, so last quarter, fiscal year to date, trailing behind the benchmark, also for the trailing 12 months, but you might remember also that we funded the new emerging markets equities mandate kind of the middle of last year. So some of that going forward should start to play out positively, we would expect. And then on page 38, go to hedge funds. So currently, the hedge fund dollars represent about 2% of the total funds, and we're making our way up. Look to bring some new managers to the board over the next couple months. But you can see here in the trailing 3 months, so last quarter, nicely outperforming our 2 benchmarks, the primary and the secondary, as well as the fiscal year to date. And then the full year, the trailing 12 months, full year 2012, it's early days, but it's nice to see that we're up about 350 basis points relative to our primary benchmark, which is the 1-year T-bill plus 4%, and we're up about 200 basis points relative to our secondary benchmark, which is the HFRI Fund of Funds Composite plus 1%. And if there aren't any questions, I'll turn it back to Martin.
Please pardon me, I have allergies, so sorry about that. On page 40, we have a summary of the total fixed income allocation. It represents about 34% of the total police pension fund, and more than half of the portfolio is in the investment grade fixed income program, the sector program. That sector program is further detailed on page 41. You'll see the 3 sectors. We're at a point now that it's about 40, 20% about in the treasury sector by policy and 40% in each of the spread sectors, 1% credit. We're underweight treasuries and overweight the spread sectors. For this particular report, you'll see in the difference column, each of the sectors outperformed. Mortgages did very well, and governments also did well, and credit did well. The underweight in the treasury sector held performance. The overweight in the mortgage sector hurt slightly by 2 basis points, and the overweight credits held by 1. Putting it all together, you'll see on page 42, we earned 47 basis points, 18 basis points ahead of the policy benchmark for the quarter. So it was a positive number, and fiscal year to date, we're nearly 3% at 294, also ahead of the benchmark by 60 basis points. For the 1-year number, we were up over 6.5%, over 100 basis points ahead of the policy benchmark, and nearly 8% for 3 years. And you'll see the returns going out in time are in the generally 6.5 to 7.5% range. 18% of the fund is invested in core fixed income. TIPS also had a pretty good quarter. And again, this was because rates were going down. In the case of TIPS, real rates. It was not surprise inflation. For the quarter, the return was 75 basis points, slightly ahead of the benchmark, and for the fiscal year to date, we're now up 3%, 3.01, and the 1-year return was 7.17. The 3-year return was 9%, even. All of these were slightly ahead of the benchmark. High yield continued to do well on an absolute basis, and we were also ahead of the benchmark for the quarter and for the year. For the quarter on the left, you'll see we returned 326, and that was 26 basis points ahead. These are now the new managers after our search, so they're fully into the program. And for the 1-year, return was over 14.5%, ahead of the 14% benchmark. You'll also notice that the 10-year return is just shy of 10%. So for 10 years, high yield has done very, very well. Convertible bonds is on the next page. The returns here are below the benchmark. The return for the quarter was 136, behind the benchmark was 139. For the fiscal year to date, it was just a shade under 6%, behind the benchmark of 7%, and for the year, 1170 behind the 1441. Four-year number is 1321, behind the policy benchmark of 1733. And opportunistic fixed income is shown on page 46. We have a little over 1% of assets in the ground in opportunistic fixed income invested, and returns are shown here ahead of the benchmark for the period shown. Is Kathy?
So we're
we'll-
gonna roll that to next month, Mark?
Okay, so we'll roll ETIs to and I'll pass over to Barry.
Okay, so with that, we're going to roll into private equity, which is on page 17 of the large book. Do you know the book?
You said page 17?
Page 17.
What, am I in the-
Got it.
Okay, so for private equity, we're talking about the quarter ending September 30th. If we look at the overall quarter, so the market value, so dollars in the ground at the end of the quarter, $1.8 billion. Unfunded commitment of $1.1 billion, giving total exposure of a little over $3 billion. The quarter was a positive quarter. IRR has increased from 9.5% to 9.6%, with the multiple increasing from 1.3 to 1.32, so directionally, clearly going in the right direction. If we take a look at page 18, at the bottom portion of the page, the portfolio diversification, here you can see by strategy where the overall portfolio is. As people remembered our last strategic plan, strategic overview, we talked about giving additional granularity of where the portfolio is. So you will see today it's clearly still a heavily focused portfolio on buyout, with 60% of the overall portfolio in buyout, but clearly looking to diversify the portfolio into different sectors, with growth equity representing a little over 12% of the overall portfolio. If we skip forward on the market overview and go to page 29, here to talk a little bit about the new commitments made during the quarter. There was one new commitment that was approved by the board, which is Trilanic Capital Fund 5, which was a re-up. That was a commitment of $50 million. And again, giving a little preview of the fourth quarter, an additional $270 million was committed during the fourth quarter. We move forward from there over to page 32. Here we talk a little bit about the returns. And I'll make the same comment that I traditionally make each quarter we do this, which is when you're looking at private equity, looking at the 1 year, the 3 year, the 5 year aren't really that important. Because again, private equity is a long-term asset class. It is a 10-year asset class. So the best way to really look at it is either the 10-year or the since inception return. And what you'll note here is the returns, again, directionally are going in the right direction, continuing to increase, and are very much in line with where the benchmark is. If we look at the lower portion of the page, which is by strategy, what you can see here is the areas of focus that the pension fund has had the greatest success. If you look at large buyout, overall IRR of 25%, those are private equity returns, and be very happy to see the overall portfolio move in that direction. That again is followed by secondaries at 17.4% and growth equity at 13.4%. As we move forward from there down to page 37. Page 37 is showing your quarterly cash flows. And what I'll note here, I would start at the second quarter and kind of work our way forward. In the second quarter, distributions outpaced contributions 1.2 to 1. If we look at the third quarter, distributions outpaced contributions 1.4 to 1. And to give you a little bit of a preview, in the monthly flip book on page 56, and I think this is probably the most important page out of the entire presentation, the flip book page will show you how successful the fourth quarter was to distributions. What you'll see on page 56 of the flip book, that number has now gone to 1.6 to 1. December alone generated $85 million of distributions to the police pension fund. So what that's showing is the portfolio continues to mature. It's positive cash flow, and what you'll note is when the overall allocation of private equity is actually pushing down because distributions are increasing. And finally, as we go to page 40, which is the final page of the presentation here, is the breakdown between public and private. And again, a comment I've made before, so I will echo it again. As the portfolio continues to mature, you'll note that the split between the public and the private will change. There will be more public companies in there, As a result, as you look at the maturation, the public companies, they take private companies, they bring them public, and usually over a 2 to 3 year period, they exit those companies. So I think the summary for the quarter was it was a good quarter. It's moving in the right direction. With regards to distributions, you all should be proud and be happy with the amount of capital coming back, and you all have done a good job with that. And with that, unless there are any questions, that would be the third quarter with a small preview to the fourth.
Thanks, Barry. Yvonne?
Or real estate, next month.
All right. Thanks for that. So we'll table that. Any other questions on the quarterlies?
I just have a quick question. I wonder if we might switch up the quarterly report a little bit next time. So I guess that would be in June. And focus a little bit more on the decisions that we make as a board versus our policy compared to what our managers are doing. You know, we really can't control what our managers are doing other than the guidelines, but we can, as a board, understand the decisions that we're making to either invest in compliance with our policy or to make decisions that from time to time may be prudent to deviate from. And I guess the thing that I'm trying to understand for myself is, as a board, what are the decisions that we've made that differ from policy, let's say over the last 3 years, that have led to this negative 66 basis point return? And let's dissect them, understand them better, discuss them a little bit more, and so that when these things come before us in the future, we might have a better idea of, you know, should we make a change? Should we deviate from our policy going forward? Has it been beneficial to us in the past? And what would be helpful for me to see is what other boards do, other public fund boards or even corporate boards do, to have this sort of self-examination or self-assessment maybe once a year or so. So I'd like to maybe dive a little bit deeper into these attribution charts so that we as a board can understand the effectiveness of our decisions.
So you're saying that we're not acting in compliance with our policy?
Well, I think a lot of times that we as a board may decide that it's prudent to do things that are outside of our long-term policy. You know, we might decide that there's a short-term reason. For example, we had a cash policy that was 0 and we were over 10% in cash. And at the time, we felt that that was a prudent decision to make. I think that we need to periodically go back and examine these types of decisions that we're making as a board, understand if they've added value, so that the next time something similar comes before us, we can have a better idea of how to make good decisions going forward.
And that's something that you want like discussed at a board meeting versus, it sounds like it's a little complicated process to look at whether or not we deviated or made some changes with our investment guidelines according to what the market conditions were. Because if I'm understanding you, is you're saying that you know, we're going to Monday morning quarterback decisions that we made insofar as what our investments were, and then either give a congratulations if we were successful or a criticism if we were unsuccessful, to the extent that our rate of return was better or worse than what the benchmark was.
I'm looking for two things really. It's how do we make those decisions? What factors do we consider in making these types of decisions? And then yes, what was the effect? Was the effect as we expected it? And if it wasn't what we expected, why wasn't it? And what other things should we have thought about at the time so that we can learn from the things that we do well, learn from the things that we don't do quite as well going forward. So it's really just a self-examination, a self-assessment that I think some boards do on a periodic basis. Barry, do you have any insight into what maybe your clients do or what you know other public funds might do on a periodic basis?
The self-evaluations that boards I work with do are not really focused on investment performance. They're more focused on governance. So how the board and BAM in this case, or staff in their cases, interact with each other, the level of respect that board members have for each other and for their staff. The focus is more on how you conduct your business, not Monday morning quarterbacking, to use Roy's term.
And I'm looking for.
But I think if you're
Yeah.
looking for an attribution of the investment results, that's a performance report.
I'm looking for two things. I am looking for that, but and also an examination of how we make decisions.
Janice, you're in the decision making. I mean, when you say how we make decisions.
Right.
So take the cash, because I'm pretty sure that the cash is the biggest determinant. We sat around monthly for probably 12 months watching the euro almost obliterate, and the board decided or reaffirmed each time that, being conservative and going to cash made sense. And then when the markets went up afterward, we put the cash back in, and as a result, on a formulaic basis, you had underperformance. You can analyze that any way you want. That's the answer. That's the question, that's the answer, and we all sat here collectively and watched ourselves do it. And, I think Roy's got a good point. If it works, good. If it doesn't work, there's a cost to it. But the policy was be conservative.
So let me, SIS does fairly detailed performance attribution for you in our report. It's not, you're using the report produced by your custodian that Martin went through. But you also get a report from SIS. First point I want to make is when we look at calendar year 2012 and it shows underperformance, that year isn't over yet. Where most of that underperformance is coming from is you've got a private equity benchmark that's up 20.7% for the year. It's a blend between 500 and 300 over the Russell 3000. However, your private equity portfolio has not been marked up yet. So let's say it's marked up 10% at the end of the year, reasonable estimate. You're right on your index now. So I'm not sure that you had underperformance in 2012 yet.
Well, that would be reflected in the manager effect.
Speak up, please.
That would be shown in the manager effect column, though, wouldn't it?
I'm just talking about comparing yourself to your benchmark. Your benchmark shot way ahead because it's marked daily, but your private equity portfolio is marked once a year, typically on 12/31, and those numbers are not yet reflected in your values or your returns. So I'm just saying, the year isn't over yet, so let's not pass judgment on the year.
Well, if I can return to the...
Let me, if I could finish. And when we do an attribution, here's what your fund did. Here's what your long-term policy index did. If you were invested in indexes, your benchmarks at your policy weights. And then we calculate something called an allocation index, which says here's what the return would be if you got your benchmark returns at the weights you are actually invested, which is sort of evaluating the deviations from your policy. So on a 3-year basis, your policy index, the long-term index, returned 9.7%. Your allocation index, which I just described, returned 10%, which says that your deviations from policy actually added value of 30 basis points. I want to make it clear, this is not versus your adjusted policy indexes. Maybe you'd get a different result if you did that. And then your total fund returned 9.1. Now, if we mark up, that will move closer, mark up the private equity. So what it's saying to me is it's really being the manager over the 3-year period the shortfall has come from activities by your managers. The board, if I could summarize it in that way, actually added value over that 3-year period. If you would attribute all deviations to policy to the board, that's been value additive. Yes.
Clarify a little bit, the 3 years ending December 31/12, the difference between the plan returns of 9.1% presented in the quarterly book, and you mentioned something over 10%?
No, we have your 3-year return for the total fund at 9.1.
Right.
The policy index, your long-term policy index returned 9.7. And the allocation index, if you got benchmarks returns at your actual allocations, returned 10%. What I'm saying is because your allocation index was 30 basis points above your policy index, that suggests that deviations from the policy added value.
In all events, though, all returns were over 8%.
Thank you, Joe.
Yeah, I just had to point that out. Thank you.
If I can return to the armchair quarterback comparison, I guess the aim of this whole reporting system or exercise that we're requesting is, if it added value, that's great. If we're adding value, don't you think we would find it as a board beneficial to understand what we're good at?
I guess my question is, you're a trustee, I'm a trustee, and I guess from the nature of the question, I'm hearing that you're not getting information from consultants and advisors to begin with, because what I'm interpreting what you're asking for is an analysis of how we make decisions and what factors come into play when we're making an investment decision. And I don't think that's something that can happen in 45 minutes at a board meeting. I think that's something that you have to do, have to have a certain level of confidence in your advisors that either the board hires or that we have entrusted with the role as being the investment advisor for the board. And I just don't see that as being something that can be put in a document that you hear for 45 minutes, because anything can be placed in a document, anything. And so how your decisions are made. So insofar as I'm not sure if you don't understand how the investments are being made, if that's the question, and you need a further clarification at the board meeting, or if it's something that you would want some type of an analysis of the overall process, if that's what you're looking for.
It's really more process that I'm interested in, and the type of things that we look at as a board when we make decisions. I know that some boards have risk budgets that they set out in their policies, and whenever they make a decision to deviate from policy, they might, for example, say, well, we have this risk budget. What does this do to the risk profile of our fund? And is this something that we're comfortable with, given the market environment, for example? So some people may have a very systematic way of making decisions and then evaluating the effectiveness of their decisions, and then always tweaking and improving upon them. And so what I'm interested in is process, results, and then an examination of the results that then feeds back into our process that we continually evaluate and improve.
That's something. So I guess my understanding in this, or to play devil's advocate, that would be too complicated for the board. I would, just to play devil's advocate, argue that...
Now, who's the devil you're advocating for?
I'll let you be the judge of this after you hear me out. So, this allocation effect that we see in these reports, the board owns that. There's no passing the buck on that. And what we are suggesting is to, I guess, delve into that further and understand, where we might be adding value or where we might not be adding value. And in my short stint sitting on these boards, I've, through earshot, understood that, sometimes we're timing the market, sometimes we're making interest rate calls. And I don't really have a sense for, are we any
I would disagree with
good?
the notion that board market times. I like that on the record. I don't think, I'll ask, people have been on this board a lot longer than me and a lot smarter than me, but I
Then what
think the
was the
notion that we
cash?
market time is not correct.
Then what was the cash deviation?
So I would tell you that the cash deviation was a policy discussion that we had with this board to suggest that anyone market times is not correct. It was a- it was
The
a
cash
pol- it was a- it was a
deviation was
policy-
made because
it
you
was a
thought that
policy-
the market was gonna
It was a
crash.
policy discussion that was transparent to everyone on this board, Justin.
Yeah, the cash deviation was because you came to the board and said the market was gonna crash, so we went to about 10% cash. I mean, you can call it what it is, but, you know, if this was an investment company and I was sitting before an executive committee, they would call that market timing, and the executive committee would ask me to.
So would you be advocating then that we would have had all that money in the market and lose it?
Well,
You know,
what I'm
but
saying,
I
what
think
I'm
you're-
getting at is.
Some people might call it risk
I
management,
think the
Justin.
issue is you were involved in those discussions at the time. So now we're looking for an analysis of the decision that you voted in favor of, you know, when we.
For future reference, we should know, are we good at doing these things?
But
That's
and
it.
and my issue is, I don't think that's a board, that's some type of a lengthy board discussion that we have in 45 minutes, because you can give me a summary, but to the extent that, you know, your question is, you know, that you're not getting information, then I'd like to understand, like, where you're not getting information from as to what goes into making an investment decision.
I guess is the reservation that we would be, as a board, spending 45 minutes on that, when that is indeed the biggest impact we have on the fund as a board. That's, the board owns the allocation portion of it, how we enforce adherence to policy, and I think
We
that.
discuss that pretty regularly at the board meetings.
Yeah, Justin, I think boards are allowed, in their discretion, to manage risk. That's their job, right? So to the extent that over a year, they went from the board, watched the pension fund, and endorsed getting more conservative, I don't know how you want to analyze that. That's exactly what happened. You can read the transcripts, you can see exactly what you said.
So when you're gone, and the board, or when this comes up again in a year, what should the board take away from that we're good at making
No,
those calls?
The board should take away that this is a very difficult thing, making investments. And investments are about judgment. You want the finest resources you can bring to the board, and you make a decision, and some will be right, and some will be wrong.
Yeah.
And you have rules, and you have balance, and you stay within the rules and the balance. And you discuss things, and again, sometimes you're right, sometimes you're wrong. Try not to be wrong, try to be right. In fact, try to be right every decision you make.
No, that's not the point, but to understand where you have strengths and where, you know, it's hard to make these calls.
Yeah, but it's judgment. There's not strengths or weaknesses. It's you're making judgment calls.
Yeah, but at a certain point, the board should be able to look back and say, do you, or does the board as a collective body have the skill, demonstrated skill at making these judgment calls? And if not, I think policy should rule those decisions, not judgment. Judgment's kind of like gut.
I don't think judgment is gut at all.
The only adjustment I think that this board has made relative to your policy allocation is that sometime in 2012, maybe it was February or March, it was decided that we would go to the bottom of our ranges in tips and sovereign debt, so treasuries.
Yeah.
And that's been the only underweight that shows up sort of consistently over these last, it's almost a year now. And I can tell you, that's been huge on the upside.
Right. But I guess what I'm trying to understand is, was that something that we had a particular skill in doing as a board? Are we really skillful at making those decisions? Or did that happen to be a lucky decision for us?
It was the result of a review you requested about our capital market expectations, which showed the equity risk premium at an all-time high. And today it's at an all-time higher. So I would say that it wasn't market timing. If market timing I call short-term deviations. Mm-hmm. This has been a year and it's still, in our opinion, a proper deviation from your policy.
So this is the type of discussion
So is it skill?
there some luck to it?
I'll take part of the credit. No, but I think and I don't, and I don't. I think everybody at the table agreed to that. There was no dissent. In fact, Larry's comment at the time was, well, that's just about where we are today. So I'll give Larry the credit.
I was executing what everyone agrees to.
So this is
All right,
very
I'll take it.
useful.
Now that we're all slapping each other on the back.
Speaking of executions now.
So this is very useful. And so one of the things that we're saying today is that when we make these decisions to deviate from policy, we can take into account market valuations and our expectation for where markets are going forward. And what I'm trying to do is to understand, again, the elements of this process that we have done in terms of decision-making that have been successful for us, so that the next time something like this comes before us, you don't want to be talking about this stuff right at the time you need to make a decision. You want to talk about it when nothing's going on and you can examine it. So here are the factors that we consider as a board when we decide to deviate from our policy, valuation being a very good example. These are the factors that we look at. And then these are the things that we come back to and re-examine going forward. So that's really all I'm talking about, is our decision-making process, better understanding it, better defining it.
But decision-making isn't just done in a vacuum. Decision-making is also looking at the world at the time you have to make a decision. And there are not always just simple rules that are applied or applicable in every world situation that we're looking at. Sometimes we have to deviate from those things. So policy doesn't necessarily dictate decision-making. You have to sometimes tweak policy, I think, when you come to these things, as we did before. And then no one could foresee, or some people say they couldn't foresee, the world in 2008 when everything was collapsing. So we went down with the rest of the world. We have to look at things at that time, and then we have to learn the lesson from there. We did, I think. I think overall, as Bob has pointed out in the past, this has been the best performing fund in the city's systems, which is good. I'm not necessarily sure I want to give a lesson to the city on how to manage a pension fund, because we don't get credit for it at the bargaining table. But either way, I think at the end of the day, we do a pretty decent job collectively, both sides, putting our heads together, getting our consultants together, and coming up with a plan. We're long-term investors. That's always to our benefit. We're not quarterly investors. We're not, monthly investors. We look at our policy overall long-term, and I think once in a while we tweak it. Is there a lesson that's going to be applicable in every situation? I don't know. I'm not that much of an expert in these things. All I know is sitting here 13 years, I think we've done a pretty damn good job on managing this fund. And that's both sides, and no one takes credit for that. So.
No, I agree with you that I think it would be helpful if once a year you would ask me to review our capital market expectations, and perhaps once a year ask me to do the in-depth performance review that I did last year. I think those are helpful reviews of both looking forward and looking backward. And I'm happy to do those.
And I'm sure Bob will disagree with you on some of those issues, but...
I would say you should do it at the end of each fiscal year. Right, you have the year-end results, we have a fiscal year, you should review those, because that's the number that counts, goes in the CAFR, goes in a variety of things that Bob deals with, that we deal with.
I would suggest that's probably the best way then, not on a quarterly, but on a fiscal year end, where you look at it and say, yes, this is what has, we do get an extensive quarterly report from SIS to review, and talk about the world as what's happened in the previous quarter. But if you want to do a fiscal year end and look at this and say, this has been your best performing, this is why. This has not been your best performing, this is why. And we could discuss it at year end. I think that would be more helpful.
Good. Ask me when and I'll do it.
Yep.
Or tell me when, not ask me.
Okay, so we're all set with that?
Yep.
Great.
Wait till fiscal year end.
Okay, so, moving right along then, 'cause I have a policy question coming up. Actually, not really. January numbers, everybody have their January reports? Anybody need one in living color?
Good numbers.
Good number, January was good. Don't annualize it, Bob. Nah. So, just a quick overview of what's happened in January. You may recall last time we got together, the big risks that come out of the system, so January was sort of a euphoric beginning of the year. Fundamentally, the economy is healing. It's slower. There was this new payroll tax and some other issues that came in, so this year is going to be on the margin, slower again. As recently as Friday, we started a sequestration. No one quite knows what that means, but it ain't helpful.
That's
Right.
Mark Page.
That's Mark Page. Okay. So again, there's a bunch of headwinds that have cropped up again, sequestration being the latest one. I would tell you that in Europe, things are kind of not feeling so good again. You got the UK elections, which were sort of striking. You got the Italian elections, they can't figure out who's who. And you got the Swiss voting to dramatically restrict compensation for executives. So I would tell you it's a little bit of a muddle. On the one hand, on the other hand, it's a bit of relief also that's gone on in the markets. And particularly the relief started in January. So just to give you some perspective, if you jump to page 39, that's why I was happy to get out of the quarter and get into the new year. The far column on the left side, the top block, or the U.S. stock market, they're all up 5-6%. January was just awesome. They're also up 5% or so in EFA, less in emerging markets. And again, the hedge against that is the U.S. government market, which was down a couple of percent, all of which was good. If you flip quickly to page 32, what you find is all that good thing made January go from 27 billion to 28 billion. So welcome to 28 billion. February, just to give you a glimpse forward, was also up a little, so we're still at the 28 billion plus level. All good. Page 33, you can see the 10-year numbers about 8.6%. The 28 looks above trend line, which it is, so don't fall in love with it, but again, I think you'll be all right for this fiscal year, barring anything totally out of the ordinary. If you look at how we're set up on page 35, you can see the asset allocation. As Barry mentioned, we can remain underallocated in U.S. government and TIPS. We're actually 0.1% under the range. I would tell you to leave it there and not rebalance. The reason I would tell you to not rebalance is I think it will rebalance naturally. And when I say naturally, if you go to page 58, you may recall TIPS is a proxy for a couple of things in kind of our parking places, one of which is real estate. If you look on page 58, you see that we're on average net probably $15 million a month putting money into real estate, so that the proxy goes away. So that the 0.1%, which is $20 million roughly, will go away in a couple of months on its own as the money gets put into real estate. I would also tell you that we just are in the process of documenting one of our New York City equity managers, as well as we recently approved these Sandy deals, which are also New York City. So it's $130 million of commitments that police have made to real estate, and particularly the Sandy things, I think are going to get invested pretty quickly. So that parking place will go away. The range is going to move on us. So again, I think we're just going to, it'll self-correct within, I don't know, 2 months without us buying anything. Plus, I don't particularly think TIPS are a very good investment at this part of the at this point in the market. If you look on page 40, the far left-hand column again, the month of January made about 3%. which adds to the third column, which is our fiscal year to date. So 7 months in, we're about up 10%. Actually, let's call it 9 3/4. I think we made a little bit of money in February, so I think you're going to find the February number is around 10. So that'll be 2/3 of the way through the year. We're up about 10%. Virtually everything made money. And continues to make money. Although, again, I think the sequestration thing is going to cause more volatility in the markets. So there'll probably be a little bumpiness between now and the end of the fiscal year, although we'll dash as fast as we possibly can, because it's nice being up 10%. With that, that's the end of January. Good month. Everything's okay. Any questions on January?
Looks good, but tomorrow could be bad.
Tomorrow is partly cloudy. I think there's a nor'easter coming. Down the hatches. It'll be a nice weekend. Okay? That's January. Catherine has some things about currency that was discussed last month. There was a request, I think last month or the month before, to talk about currency. Catherine has a handout, and I think Gary has some comments as well. I'm going to grab some water while you start when you feel like it.
Start whenever you're ready. So what we've handed out is some charts on the geographical exposure for the police pension plan. This is the numbers are as of December 31st, 2012, just to get us to the right place. And really what I'm going to do is just set the stage for Barry to talk about currency hedging and how that fits in. But first, I'm here to describe sort of the order of magnitude of how much currency exposure the system has. If you turn to page 2 of the handout, on $27.2 billion, this is the asset allocation. The thing to focus on is that primarily the international currency exposure comes from emerging markets and IFA in public equities, which totals approximately 16%. If you go to the next page, this shows us that the total exposure is $4.5 billion, which is actually 16.5%, because we have some dribs and drabs in fixed income, private equity, and public real estate. But again, the bulk is public equity markets, IFA and emerging markets. On page 4, just for the record, we're showing the active versus passive breakdown of the international exposure. We're 3/5 active, which is 2.7 billion, and 2/5 passive, which is 1.8 billion.
60/40.
66. In terms of we're drilling down just to the next level. On page 5, it's the regional exposure, ex the U.S. So we've taken the U.S. out of the picture. And this shows that almost 50% is in Europe, and the next largest is in East Asia, the blue and the red. And finally, on the last page, we have the currency exposure. You can slice this by geographic region, by currency, so on and so forth. This is a slightly different view. It's currency, which primarily eliminates our ADRs. And there we have 4.4 billion in currency, or 16% of the portfolio. Okay, Barry.
Okay, thank you. So just to summarize, so if you look at the total portfolio, somewhere just north of 20% of your assets are exposed to foreign currencies?
Under.
Just
Under.
under 20%. Of that, let's call it 20%, 96% of that 20% is tied to currency exposures to equities. And of the equities, it's about a little more than 1/3 emerging and a little less than 2/3 developed. Now, if we looked at how the market, the cap-weighted market is, non-US market is exposed, it's about 76% developed, 24 emerging. You're about 65-35. So you're overweight emerging markets and therefore emerging market currencies. And I know I'm not supposed to get tactical, but I'll tell you, I love emerging market currencies. And because my wife's in public office, I have to disclose every trade I make. And so I don't like to trade. And in 2010, if you'd have asked me if you could make an investment and hold it for the next 10 years, not worry about it, what investment would you make? And I actually was asked that question, and I actually did it. And it's probably more than one investment, but I built a portfolio that was long emerging market currencies, a basket, and short the dollar, the yen, and the euro. And it's been a good investment, especially this year. But I do, that just shows you that I have.
Market's doing that right now, Barry.
I think that the emerging market economies are in such good shape relative to the developed market economies that is exposure you really should have. I don't know if the dollar's going to outperform the yen or the euro. That's a hard question to answer because all three of those blocks are in a race to the bottom. They'd all like a cheaper currency so they could export more. But I do feel very confident that emerging market currencies will appreciate relative to the dollar. The other important thing about Catherine's review is that fixed income, foreign fixed income, is only 1%. And I'll tell you why that's probably germane to the question in a minute. So if you look at the paper that we did, what I'm talking about today is just, should you have a policy hedge on your foreign currencies? Should you be taking some of that foreign currency exposure and hedging it back into dollars? As a policy, a long-term approach that is in your benchmark. And our answer is no. In fact, our answer is until those foreign currencies get up to 50-60%, the answer will be no. So that's a pretty strong no. What I'm not saying is don't deny your managers the ability to hedge currencies if they think that's a good way to add value to the portfolio. Don't not consider hiring a currency manager to take advantage of some movements in the currency markets. So I would not be opposed of hiring a currency overlay manager in the production of excess return, not necessarily to have that bet in place forever. But what I am talking about is don't put it as a policy hedge in your benchmarks. And I'll get into the reasons why. One is generally currencies are an inflation hedge. If inflation is higher in the US than it is overseas, you're going to be glad you had that currency exposure. And that's because over the long term, currencies are priced by what's called purchasing power parity. I'd rather call it the Big Mac rule. How much does the Big Mac cost in Japan versus the United States? And you'll find it's much more expensive in Tokyo than it is here. So that would say that the yen has to depreciate relative to the dollar over the long term to get back to parity. The more specific reason why you shouldn't hedge is what we call exposure to imported inflation. And that means that your beneficiaries, the retired policemen and their spouses, have exposure to currency markets because part of what they consume is imported. So if inflation in the US is higher than it is in Europe, and they want to buy a BMW, they can hedge a...
Our members can't afford BMWs.
Okay, an Opel. They would be well off to have exposure to the euro to offset the increase in price due to a more expensive euro. So if you look at the second page, there's a big table in there that breaks down United States gross domestic product, the GDP. And maybe some of you knew this, but GDP has 4 components. It's what we consume, it's what we invest, it's the difference between exports and imports.
That's not in the presentation.
Oh, it was a handout, a separate mailer. And what the government spends. So the US GDP in 2010 was $14.6 trillion. Consumption, what we consume, was $10.3 billion. In other words, 70% of our GDP is consumption. I think you've heard that figure. It's very constant. Our economy is 70% consumer driven. It says that imports, what we import, is 18% of GDP. So if I take the ratio of 18 over 70, assuming that we consume everything we import, which we probably do, why else would we import it? That says that 25% of what the average American consumes is imported. So this is just common sense. This wouldn't come through in an optimizer, it wouldn't come through in an asset liability study, an asset allocation study, but it just says, commonsensically, we should have about 25% of our assets, a minimum of 25% of our assets exposed to foreign currencies to hedge our beneficiaries' risk against that imported inflation. Now, I'll be the first to admit it's not a perfect match. Our biggest trading partners are Mexico and Canada, and they're a small piece of IFA or the world map, but it's a pretty darn good rule. So that's a bare minimum. 25% should be exposed to currencies before you start hedging that currency risk out. Now, next we look at historical performance efficiency. And how would you have performed if you were hedged at certain levels over the last 14 years? Now, you might accuse me of cherry picking the data. I'm not. I picked 14 years because that coincides with the introduction of the euro, which is a big event in the currency markets. It took 13 currencies out of circulation. It also coincides with when Russell started publishing their indexes, and Russell publishes a hedged international result. Now, we could use the MSCI indexes and sort of in a ham-handed way come up with a hedged portfolio result, but it's not perfect. And this chart is very hard to understand. I'll try to tell you. If you look at, you have color? Yeah. The blue bar that goes way to the right. That starts at 0, and we're looking at 60-40 portfolios, starting at 0% international, and then each of the triangles goes up 10% till you're 100% international, and this is completely unhedged, no hedging. So you can see the more you had in international, the better you did, the more return you got, but you also got it at a price of higher risk. If you look way to the left, that purple line, that's 100% hedged. And starting at 0, international going out to 100%. Now, the germane line for you to look at is the orange one. That's a portfolio that is 50% hedged, and it's germane because most people who adopt hedging policies say, let's hedge half. I don't know why, but that's what they do. And if we start out at 0% international and go up 2 triangles, we'd be at 20% international, right where you are today, 20% international. And then I would compare that triangle to the blue line, second triangle up, the one way to the right, 2 triangles up from 0. That's 20% unhedged. So you had a significantly higher return, probably about 15 or 18 basis points in that range. And you got it at a price of maybe 45% more volatility, or a Sharpe ratio of about 0.3. Pretty darn good. That's pretty efficient. On the next page, we actually do the math for you and compare all the Sharpe ratios running on from top to bottom, from 0% international to 100%, and then from 0% hedged to fully hedged. Again, the germane line for you is 20% international. And as we move from left to right, you see those Sharpe ratios going down, which says you are better off not being hedged. We highlight in bold the areas where you would have been better off with some sort of hedge. And those all occur where the international exposure is 50% or greater, and the most you should hedge under any circumstance is 75%, and that only occurs when you're 90% international, or 100%. And if you're about 50% international, you should only be hedging about 25% of your currency risk. So in summary, the short story is you're in a fine position by not being hedged at your exposure level of 20%. When it starts getting up to 40, 50, 60, we should start thinking about it again.
This 50% level you cite, is that, I guess, appropriate to a U.S. public system whose liabilities are denominated in dollars, or is that more of an endowment sort of a weight?
50% international?
Mm-hmm.
Well, we have clients that have gotten there.
And they're public?
They're public, yes.
Benefit?
Mhm.
Is that more of a global equity allocation versus a U.S.?
Yes. So if you were a global investor, you would have today about 53% outside the U.S., 47% in the U.S. So that gets you close to 50. Yes.
Do these numbers take into account the expense of the currency hedging?
Yes. That's one thing Russell does that MSCI doesn't do. So they make an estimate on the cost of hedging.
And approximately what would you say that expense is?
Well, in the developed markets, it's probably something very close to LIBOR. So today that might be about 25 basis points. In the emerging markets, it's significantly more expensive than that. That's if you're doing swaps. I think if you did forwards, it would be a little bit cheaper.
You mentioned PPP, purchasing power parity, during the course of your presentation, and said that from a policy standpoint, say if you're comparing 2 currencies and one of them is meaningfully overvalued by PPP, that would be grounds to have a policy hedge against it, or could inform the decision not to have a policy hedge.
The latter.
In the case of, the plan's currency exposure, I see most of it's in the euro, and I don't know the exact figure on PPP, but I know it indicates that the euro is around 20% overvalued versus the dollar. And I understand, your argument, or your your thesis for emerging market currency hedging exposure, but if I were just to look at the fact that we're mostly denominated in euro international investments, and that the euro is about 20% overvalued versus the dollar, I guess that would lead me to question, why it's prudent not to have a policy hedge.
You just made a judgment call, not to interrupt you, but you're just timed the market.
Market timer.
No, that's policy, actually.
No, you just said, as if it was a certainty, it's 20% overvalued.
No, that's based on PPP. You can go to Bloomberg and look it up.
Oh, Bloomberg.
Excuse me, General, let me get some water.
Well, specifically about the euro, part of the higher prices in Europe are the inclusion of a value-added tax, okay? No matter what you buy. And those are about 18 or 19%. So that might explain just about the whole differential. So I wouldn't
And with
be
regards
hedging
to the yen?
based on that. Pardon?
With regards to the yen?
Well, I don't think we as or you as a board should get into regional discrimination. I think your investment managers, your international investment managers, if they believe that the yen was expensive, that they should be hedging out the yen exposure. And personally, I think the yen has depreciated relative to the dollar by about 20% in the last 3 months.
Very quickly.
Ever since Abe was elected prime minister. So there's been some movement, but in my opinion, it has more to go. Japan makes Greece look like a savings country. Their debt to GDP ratio is about 350%. But that's not for us to do. That's for your investment managers to do.
Okay.
So
Unless you want to hire me to manage currencies for you, I'd be glad to do it for 50 basis points.
Yeah, I'm curious though. PPP is based on long-run valuations, which is kind of the same input we use for strategic asset allocation assumptions and capital market expectations and the like. Is that not the
No,
case?
purchasing power parity is a point-in-time observation, but the theory says it takes a long time
to unwind.
to unwind, yes.
So therefore, it would be a strategic input.
Could be.
I just wanted to make sure
Yeah.
my understanding was correct.
I think if there were
For
only,
those who are saying I'm making a tactical call.
if there were only two currencies in the world, the dollar and the yen, I think that would be appropriate. But the investment manager doesn't have to just hedge back into the dollar. He could do a cross hedge, and maybe the really cheap currencies, the emerging markets, is what he'd hedge that yen exposure back into. So I don't want to be in a position of calling which currency to hedge back into, even if I had an impression that a certain currency was overvalued. There's two parts to that decision.
So to summarize, we're about 20% international currencies, and you say we shouldn't worry about hedging it until we're double that.
Yeah, or as we approach double that.
Right.
Mhm.
And then if we have a short-term investment, as opposed to a long-term investment in non-dollar exposure, then we should allow the manager at their discretion to hedge currency. Is that the other point that I heard?
If the manager has that skill, yes.
If the manager has
Mhm.
the skill. And if not,
If we, in theory, that's what we bought then. When you analyze the manager, that's part of the package. You wouldn't direct him unless he had it right. So if you hire XYZ EFA manager, let's say, when you analyze their ability to manage that, you look at an array of numbers that have been hedged, that's one decision, versus an array of numbers that's unhedged. It's part of the whole package as to what you bought. Right.
Right. And so I guess like the whole thing that started this discussion was our consideration of a manager who was going to have a very sort of a lower return, projected to have a lower return in the portfolio relative to a potentially high volatility due to currency. And we were questioning whether the risk-return trade-off was favorable. And said, could we, I guess this manager didn't have the ability to hedge currency for us, and we asked the question, could we hire a currency manager? And the answer was, there's nothing in our policy that allows that. So that's kind of how we got here today. So what changes should we be making to our policy to enable us to manage currency if the need arises or if the board decides that it's beneficial from a risk-return perspective?
The board just decided not to hedge currencies, regardless of managers. That's what Barry just said.
Until we start approaching more than.
Well, as a policy, I was talking about it as a policy. I'm in favor of allowing managers to hedge currencies. But if a manager doesn't have that capability, I'm not in favor of going and hiring an overlay manager just to supervise that manager's currencies position. I think the manager is aware of those risks. Now, and I'm not familiar with what AXA does. They just say they won't do it or they can't do it.
No, AXA could have hedged. Problem is it's quite expensive.
I'm sorry,
because we
I couldn't hear
don't
you.
post.
Okay.
Oh. It would have been, AXA certainly would have hedged. And you roll forwards, do some swaps. We as a city don't post collateral. So they have to reserve some of the funds and not fully invest to have money for collateral, which made it, in our view, prohibitively expensive.
But let me.
And if you posted collateral, that would go into the basket, correct?
Well, forwards would, we got some opinions on the basket, but it was an expensive hedge.
Let me try it differently. There are some managers we have, they're called hedge funds, whose business is to trade currencies, and that's part of what we hire them for, right? If we want to have a macro hedge fund, and we have a couple, part of what we hire them to do is make money on currencies. That's their job. If we hire a debt real estate investor in Europe, that's not his job to figure out currencies for you, and there's no assurance that they know how to do it. I would tell you. We didn't hire that firm to manage the currency risk because that's not their job. That's not what they do for a living, as opposed to a macro hedge fund, that's their business. They decide what currencies they like. If they want Big Macs in Japanese versus Big Macs in the US versus the Euro Big Macs, they can do that. We hired them to do that based on their track record to do that. We hire a European real estate debt manager based on their skills in European real estate debt. Subject to Barry's, you should have this much real estate, not this much. Up to this amount of foreign currency exposure is good to have in your portfolio. It has its following attributes, and they're part of that subset, the European debt manager. Otherwise, we don't know who we're hiring, and we're subjecting another layer of execution risk on that manager.
So then I think it would be useful going forward as we do these evaluations of these managers that don't have the ability to hedge, and we've decided that as a policy we're not going to hedge on a case-by-case basis, to do some scenario testing to show what the potential risk-return effect could be with regard to various currency scenarios. And that way, it factors into your decision-making, and you say either, given these potential scenarios, we still think it looks like a good investment, or, you know, it really looks like we may not get a favorable risk-adjusted return under these certain scenarios, and have that be part of our decision-making. So I think going forward that ought to be something that we examine.
Fair enough. Okay. more discussion on currency?
Anyone want to summarize what you think?
So, no hedging for now, as a policy. I think what Janice is asking is, as part of the manager evaluation process, we include their currency expertise and willingness to do it as part of their evaluation. Correct?
Yes.
So let me just ask one follow-up question then. So, Janice, how would you have us analyze a euro-denominated buyout fund? What would you like to see?
You would want to do some sort of a scenario test to see if the euro becomes, 20% overvalued from where we are today, or 20% undervalued from where we are today, and the effect on the return of the fund, as well as the risk of.
Isn't the return then plus 20%, minus 20% under your scenario?
Right, but then there's volatility in there as well. So it's not just the return, but it's the volatility that the currency injects into the return of the fund. So I guess what we're looking for is a favorable, not just a return trade-off, but a risk-return trade-off.
But you have a policy that says you think we should do, I think it's 20% international, mostly Europe, in private equity. That's the policy that we've all
Sure.
approved, right?
Mm-hmm.
Okay, so to the extent that Barry Miller shows up with a euro deal that's on our annual plan, is that all right?
I thought you, Janice, your point was that you thought that was important when the holding periods were shorter,
That's right.
which wouldn't apply to a European buyout manager. Would not.
Right.
But if it's a equity manager who trades in and out of positions, then that becomes part of the evaluation process. But I wouldn't say that would apply to your scenario, Larry.
Okay. That's not that different, by the way, than euro-denominated long-term debt on real estate, long-term assets.
I'm not arguing with you.
Okay, I just want to circle back to what we just said, You have to make a decision as to what our risk tolerance is for currency, which I thought you laid out perfectly well. We can mention it, we do reference currency exposure in anything that we do that's a different currency. Sorry.
So in the case of AXA, which I think is what triggered this conversation, what we would want to see is what would it cost to hedge away the currency risk?
You saw that, I showed it to you.
I know, it said something like 10 or 20 basis points. Is
20
it?
or north.
20 basis points, and then compare that with what sort of volatility reduction that would entail, what the correlation of the volatility is to the return source, i.e. since euro volatility is very heavily driven by credits and sovereign risk factors. And then from there, you can back out what a risk-adjusted return assumption is if we're hedged or unhedged. And if one of them has a significantly more attractive risk-adjusted return profile, that seems like pretty good grounds to apply a short-term hedge. And then the fund can go take its risk in areas where it's being better compensated than just riding the tiger on short-term currency.
I think you just ignored his entire presentation when you do that.
I'm afraid that we're getting to a situation here where the board is micromanaging. And I don't think that's a healthy condition. I'm just going to say that. These are a small, very small piece of the portfolio.
And I might make the observation that on any individual investment, even if one could make an intelligent bet of knowing where the markets are going in the future on the currencies, why wouldn't you apply that same theory to the portfolio as a whole that's similarly affected? It does, I would just reiterate Barry's comment, I think that the policy level decision the board has made about basically not hedging, because there's no demonstrated value to doing it at this point unless you know something you don't know. Trying to carry it down to the level of individual investments, well, if you're going to go foreign and you're going to have currency risks, you just got to decide if you're going to do it or you're not. And the board historically has decided to do it. I don't think you can gain a lot by looking at individual investments, individual managers. And if you could, then at the policy level, you'd want to do the same thing for every other manager similarly situated. So I thought Barry's analysis was sound, it was excellent in terms of the policy level discussion, but how one introduces that into the ongoing operations, I don't think can be done one entity at a time. That doesn't mean it isn't a good discussion to continue to have over time, because situations could change. Sorry.
Joe, was that a good summary?
It was slightly shorter than the actual presentation. Hey. All right, I think we strangled this turkey long enough.
Okay. So that ends the public agenda.
All right, do we have a motion to exit?
Motion to exit the public session and go into executive session.
Second?
Second.
Okay, so moved. Let's give them 5 minutes to break down the cameras.